educate all of you and help you look at these numbers, understand what it means, and see if it makes sense for you. Because a lot of real estate investing is very personalized, and so this is an educational opportunity. It's often a steep learning curve, and make sure you're dropping all your questions in the chat. We'll get to all of it on the back end, whatever platform you're on. If you're on Zoom with us, if you aren't on Zoom, Adrian, on Facebook, can you drop the Zoom link in there? It's just I love looking at you, seeing all of you, and having face-to-face conversations. If you want to join us on Zoom, that would be awesome. But we'll make sure on the back end we have time to answer everyone's questions. With that being said, let's get started. So we're excited to present the Hamilton, which is our next opportunity, which is in a great submarket in Nashville. As always, our goal as we grow the community is to really leverage the community and ensure that our investors, our community gets better terms when you go into the deal, no matter what your check amount is. And we've been able to do it for this deal also. I'm so super excited. Before we get started, just a reminder, everything that's on here, a lot of the numbers are projections. So keep that in mind, right? And so this is what we hope to achieve, but they are just projections, and I'll help you walk through that. And at any point, if anyone wants to deep dive further, you want to see if the opportunity it makes sense for your personal situation, or you have other things in your portfolio and you really want to see if this is a great fit, feel free to book a call with the team. But a lot of this is educational, and a lot of the numbers you'll see are projections. So please bear that in mind. And make sure you're doing your own due diligence. Adrian, if you could do me a favor and in the chat, drop a link for book a call, just in case someone on here wants to book a call with the team on the back end. But how we're going to run this is I'm going to start off. So our community keeps growing, and so every time I'm on here, there are people who are new to the community. So I'm going to take a few minutes to introduce myself to all of you, introduce our, Tommy, who is our head of investor relations, and we'll talk about GW Capital. We'll talk about the deal per se, right? What makes this a strong asset, why we really love this. We'll talk about timelines, what you want to do if you want to invest in this opportunity with us. And on the back end, we're going to have tons of time for Q&A. So like I said before, if you're just joining us, make sure you're dropping all your questions as you go through this. And again, it doesn't have to be specific to this deal. If it has to do with the terminology, if it has to do with real estate in general, more than happy to answer all of those questions. And especially if you have specific questions for the opportunity. And so that being said, let me reintroduce myself. Most of you know me. I'm Param. I'm a radiologist in Southern California. I used real estate to get to financial freedom decades earlier than I would have otherwise. And the goal with building the community, it started off with the Generational Wealth MD community, and our coaching program was to help other physicians learn to introduce real estate and alternative assets into their portfolio. So it really helps them gain momentum, and have the ability to hit financial freedom much earlier and have options, right? And so we're at over 20,000 members in the community at this point. And then GW Capital is the part of the company where we're helping investors who don't want to go and build their own portfolios, but want to stay passive in real estate, come in and invest with us passively. And we assist with due diligence. We're doing due diligence on all of these assets, but we've grown to over 375 million in assets in partnership, over 1,500 doors. I'm very proud of that. And again, this is our opportunity to serve those of you who want to stay truly passive, but still get all the benefits that real estate affords, the returns, the diversification, the lowering of the risk profile, and tax efficiency, right? And this is a look at our portfolio. All of this is in the slide deck. If you haven't had a chance to look at it, that's gwcapital.com/Nashville in lowercase. But, I really want to take the opportunity today to introduce all of you to Tommy. Tommy Brandt, he is our head of investor relations and operations at GW Capital. And I've loved working with Tommy. He brings so much to the team. Most of you know Adrian, and you've interacted with him. So you'll be hearing a lot from Tommy when you book calls, or if you're interacting with us. He's definitely a numbers guy. He's an electrical engineer and a data scientist. And he has been syndicating multifamily offerings since 2021. I'm going to actually pause here, Tommy. I'd love you to unmute and actually talk to the
Sure.
community, introduce yourself a little bit better. But I see him as someone I strongly lean on. We've loved having him in the team. And he's also, I don't see this in here, but he's also very hands-on with asset management. So I think he's a fabulous addition to the team. Tommy, all yours.
Nice. Yeah, thanks for the opportunity, Param. I had a hard time holding it in when you're like, we're up to 1,500 units now. I'm excited for the 2K mark, so let's get there. So hi everyone, my name is Tommy Brandt. Yeah, I'm here to support Param and anything operations or investor relations. She's getting to the point where I think we could all use a little help and with what we're doing and growing our business. So I'm excited to be a part of the team and help support. So I'm based in Nashville. I'm actually not too far from the subject asset that we're going to be talking about today. But yeah, I started investing in 2011, single family, graduated to multifamily, and then people started asking me, hey, how do I get to do what you do? And so started bringing some other folks along with me. And so, decided to team up with Param. And yeah, we're excited for this asset. I'm excited to be here. Consider me a resource. If you just have general questions or specific questions about prospective investments or past investments, I'm very well acquainted with the portfolio and I'm happy to help.
Awesome. Thank you so much, Tommy. And, all of you are going to be hearing more from him. He's truly here to support and serve, and he's a wealth of information. So definitely you should, as you lean into me, he's also there for you to, to support you in your journeys. Okay. I'll quickly talk about GW Capital and Generational Wealth MD, essentially. And a big part of why we're growing the community and educating is because for me, I really wanted to have autonomy. I think as physicians, we serve better when work is optional, and the whole goal is to help us generate significantly higher passive income. And it all comes back to this slide. When I was at Fiji Life and Wealth Conferences, the Tony Robbins event, where they were talking about wealth mastery, and the single biggest takeaway, always, for most of us, is going to be, what is our asset allocation, right? And although we think investing in a particular stock or trading is what's going to get us, or working more and saving more is what's going to get us faster to the retirement. What actually makes the biggest difference, 90% of a portfolio's returns stem from asset allocation. And most of us, right, the bulk of what we have is in terms of retirement accounts is in stocks and bonds. But if you look at the wealthy, they have about 50% of their asset allocation in alternative investments, which is real estate and businesses, private equity. And not to say that all of us need to have the same asset allocation, but we really need to get to the point where we have at least 20 to 40% of our assets in alternatives. There's a strong advantage to that. Not only does it get us higher returns, it also diversifies risk. By diversifying, it reduces risk in our portfolio because now we're in non-correlated assets to the stock market, especially in the environment we're in right now with tariffs and pro-inflationary policies and uncertainty. What really gives certainty, even in these times, is our real assets that are cash flowing, right? Which is all the more reason why, and I think a big part of what we do in the community is reduce those barriers to really having a very balanced portfolio. And in a sense, if you had to sum it up, that essentially is the mission, right? With the end goal of giving us our time back and making work optional. And at GW Capital, again, we strongly believe in personalizing your portfolio, which is why we always encourage you to have conversations. If you want to know if this is the right opportunity for you, if you haven't built out your buy box and you need assistance with that, we're here to support you. Again, a big part of personalizing the way your portfolio looks at different stages is also going to be different. And it also it depends on your income, your savings, what other assets you have in your portfolio. And so we're here to support you, right? So this is not a one size fits all. A big goal for us is educating you so you learn to have a personal portfolio that's geared towards your risk tolerance and your goals, right? At the same time, if you look at our deals, even in this deal, right, we're always negotiating and leveraging the community to get better returns for our investors. So compared to retail investors, you are getting higher investors when you go through this deal because that's what we're able to negotiate because of the size of our community. And that's a goal for us, right? We want our investors to get higher returns. We want you to have diversification across markets, across asset classes. We've been, since Tommy came on, we've been underwriting some mobile home parks. Also, we're looking at other assets, parking, other assets that, again, with the goal of diversifying, reducing risk in the portfolio while maintaining those returns, right? And it's always about asymmetric risk reward. That's what we're focused on. We're also very conservative in how we underwrite our deals. We're very picky in the deals that we go into. And I think for most of us as physicians and professionals in this community, being conservative and capital preservation is top of mind, as it is for us. But we're our goal is to help you really introduce alternatives of real estate into your portfolio, right? So you're getting a more balanced portfolio and exposing you to the tax efficiencies that real estate has. Okay. And Another big part of our mission is our charitable mission. We are working strongly with teams on the ground to also have a medical mission towards the end of this year that helps underserved communities in parts of India. And we're helping kids with disabilities in rural India, thalassemia, hearing impairments. So I want all of you to take pride in it, right? As physicians, as professionals, impact investing is huge when you're doing good as we're investing and improving our financial situation, that there is a lot of meaning to it. And I want you to take pride in it. All of your support makes that possible. But again, like I said before, education is the core of what we do over here. And so for those of you who are new, fairly new, and really want to understand, because a lot of the terminology, you may be hearing it for the first time, but if you really want to understand investing passively and you want to know how to build your buy box, right? Want to learn how to personalize your real estate portfolio. If you want to understand how to vet the market, the deal, the sponsor, and if you want a simple due diligence checklist where you can go in and say, hey, how do I know if this deal is conservative enough for me and it meets my risk tolerance, then make sure you download the guide, gwcapital.com. It's a great resource. It's a labor of love. You probably heard me say this before. And it was built with the goal of having all of those of you who are relatively new to real estate investing to actually be able to go in and within a couple of hours really come out knowing more than 90% of people who invest in real estate. But that being said, we educate and that's a great resource, but there's a lot of momentum and power in in-person events. Like I mentioned, I was in Fiji for Life and Wealth Mastery. I got to meet a lot of amazing physicians in our community and spend time with them. The learning that happens in person is very different, integrating the concepts that you learn, building connections, having accountability partners, right? All of that is something that is unmatched, which is why this year, for the first time, we're having our Physician Freedom Summit in California in October. If you haven't signed up, sign up. I'm always skeptical before I go to events. I'm like, okay, I can learn this. I mean, what am I gaining? But every time I go there, I walk away saying, I had multiple breakthroughs. I've made such meaningful connections that are really shaping the trajectory of my life. So if you haven't signed up for the summit, make sure you do. It's generationalwealthmd.com/summit in lowercase. It will be CME eligible, so you may be able to use CME money for the trip. It's in October at the Langham. Like I said, location matters. We're going to have wellness events. We have when I was about mastery, what I felt was what we cover in half a day is what they covered in 3 days, right? So the concepts you're going to learn in terms of alternative investment strategies, wealth strategies, tax strategies, it's going to blow your mind. It's a no-brainer. If you haven't signed up, please do. These, and Tommy knows this, these events take a ton of time and effort, but we do it because we see the value in it. And I want you to have the same experience that I do when I go to these in-person events. I want you to learn the same thing. Okay. Having said all of that, let's move on to this deal, right? So for those of you who've invested with us in our last deal, the last two opportunities we had were in December last year. We've had a bit of a hiatus, and that's because, again, before we get into any opportunity, it kind of really needs to check all the boxes for us. So super excited to present this opportunity. And for those of you who are new to real estate investing, for some of you have probably already seen this, you know what I'm talking about. When you invest in real estate, your returns are not just the cash flow and the cash flow that you get from these deals, right? For those of you who are already invested, the cash flow that you get, it's mailbox money, gets deposited into your bank account every month, right? You're literally very passive in this after you've done your due diligence and you've signed the paperwork. But all of that is tax-free because of depreciation, right? We still get to benefit from it. And we're going to talk about that soon. So you're looking at, okay, the reasons you're doing this is because you get tax-free cash flow. Real estate is one of the best, especially leveraged real estate is one of the best hedges against inflation, right? And so you're tapping into that. And so if we are in an inflationary environment and people who have their capital in savings account, but while their purchasing power is eroding, when you're invested in leveraged real assets, you're keeping up or exceeding inflation, right, in terms of return. So it's a great inflation hedge. You get market appreciation, especially with leveraged assets like this, right? We have 70% leverage, so your returns are amplified every time the market asset values increase with inflation. We also have a plan for it's not this deal is not your typical value add deal. And remember, every time we have deals where we're forcing appreciation, we're rehabbing the property or doing things to increase our revenue. We're actually getting a bump in revenue, and our profits are increasing. This deal and that usually entails a small amount of risk, right? Because there are variables over there. This deal is a completely rehab deal, which is why we love it. But there's still opportunity for forced appreciation, so we're tapping into that. And then, like I said, we're tapping into the tax efficiencies of real estate. There are ways to structure the deal where you don't have to pay taxes on the income that hits your bank account, and there's a way to defer having to pay those taxes even on the back end during sale. And you have the ability to tap into that. And for all we know, 100% bonus depreciation may be coming back. We'll know more within the next month. If it does, that'll be a great boost. But even without that, right, you're tapping into all of these returns that you get from real estate. And that's what I want you to keep in mind. When we go over the slides, we'll talk about it. But this is an opportunity for those of you who are passive to still benefit from all of the advantages of real estate. And all of you know this, housing affordability is near record lows, right? Which means more and more people need to rent, right? With interest rates being so volatile, with home prices being so high, without, in the single family space, we did not see a drop, right? Because transaction volumes are low, because people are locked into 3% interest rates. All of that contributes to housing affordability being pretty low, which means that there is a lot of demand for renters, right, for rentals. And this is a great strategy in the current economic environment. Same thing, interest rates are volatile, which is another reason why it's been really hard to make deals pencil. But again, this deal, and I'll talk about this, we're getting fixed 4.89% interest rate because we're assuming the seller's loan for the next 4 years. And that makes this deal positive cash flow day one. We have positive leverage on it, which again is very hard to combine in this environment. So, which is why we're, checked all the boxes. That's what we're looking for. We're looking for that buffer day one. And this asset meets all of those criteria, right? And so going into the market, and I'll start off over here and I'll hand it off to Tommy so he can take over. But again, it's one of the, and Tommy we'll deep dive more into this because he is from the Nashville area, but it's located in Hendersonville, one of the submarkets in Nashville, where and it's an affluent, A-rated submarket there, but there's massive supply constraint. I believe there are only 250 units that are going to hit, are in the pipeline right now that are going to hit the market in the next 5 years, which is great, which means that assets that are already built over there retain their value, and there's demand for it. And so so we can expect good organic rental growth over there. Schools are A-rated. And again, it's one of the most desirable areas to be in that location. And like I said, supply constraint is one of the, again, we're always looking to see, okay, what's going to happen with occupancy and supply? What does that pipeline look like? And this is an area with supply constraints, which means there is good demand, which is going to lead to favorable rent growth over time. The asset per se, like I said, and we have a slide coming up. Assets where we go in and do value add, those are great because we're able to push returns significantly, but it comes with a little bit of risk, right? There's the added risk because we're doing the rehabs, there's an expense over there. Building costs can go up based on our trade policies and inflation. And so there are variables over there. This is an asset that was completely rehabbed by the previous sellers. The roof was replaced in 2024. The complete rehab was done in 2020, which means that it is a lower risk asset, right? Again, it has, because of the rehab and just its location, it historically has had over 97% occupancy for the last 18 months. Now, that is huge, especially in the current economic climate, right? And so it just goes to say, it talks about the demand supply dynamics in that submarket. And so it checks the box over there. Minimal capex needs, which means it's already recently rehabbed. There aren't a lot of variables where we can have large ticket expenses. And one of the things we really love about this is what I talked about, the interest rate, right? And which is why you haven't seen us bring something to you guys in the last 6 months. It's because it's really hard in this environment to have assets that have positive leverage, where the cap rate over here going in is 6.14%. Interest rate is lower, which means we have positive cash flow, right? And so seeing that positive leverage, that's something that has been hard to come by. And so we're super excited to find something where, we have a fixed rate agency debt on this asset. It's lowering risk. And you've heard, for those of you who are new, the two things that I really look at and the two things that introduce the most risk to multifamily investing is debt, right? When you have variable rate debt and interest rates go up, there's a variable that you have no control over. And that is why we're seeing a lot of assets acquired in 22 and 23 that are distressed, right? So we have great debt over here, and we have positive cash flow day one. Those are two things because that's a buffer, right? Even if something goes wrong, cash flow may drop, but you have that buffer before you start going into negative territory. So again, those are things we're super excited about as far as the asset goes. And the business plan is there is a loss to lease, which means compared to what market rents are, the properties can rent for up to $400 more based on rent comps. And so that is low-hanging fruit. One of the easiest things to do is for us to go in, bump up rents. We're also looking to install washers and dryers, which is going to give us a small pop. And the good thing about multifamily investing is, end of the day, your asset value doesn't depend on as much on what others around you sold the property for. A big factor over there is the revenue that you're generating from these properties, right? So every time we're able to go in and bump up revenue, then we're able to increase the asset's value, and that's how we're able to get our returns on the back end. And so again, very low risk business plan that we can easily execute, but we still have room over there where we're not just banking on market appreciation. There's more that we can do in order to bump up revenue. Okay. So a few more questions before I hand it off to Tommy to talk about the asset per se and the market. But sometimes, for those of you who are new to the community, a big question is, okay, how are we getting higher returns? What do those returns look like? Most of you want to know, if I put in 100,000, what is that going to look like over the course of the next 4 years? Now, keep in mind, these are all projections, right? These are pro forma numbers. And so a lot of it is going to depend on how we are able to execute and market conditions. But if we go according to plan, these are the returns that we can expect. That being said, we have a three-tiered approach for this asset like we've had in previous deals, and I'll go over it. And it's also going to show you, and all of this is in the slide deck. It's also on the page when you go to gwcapital.com/Nashville. You'll see a slide deck over there. This is in the slide deck. It's also on the page. But I just want to show you what you can expect just to get you numbers. If you put in 100,000, what are those numbers going to look like? We'll talk about that. And how are you getting higher returns as a GW investor? We'll talk about that. And then on the back end, some of you may be wondering, do I do Class A? Do I do Class B? Don't worry, I'll get to it on the back end. But I'll just get started over here. Now, the minimum investment is 50,000 for each of these, right? And if you non-GW investors with a check size under 500,000 get about 7% preferred returns and a 70-30 split. Our investors for Class B get an 8% preferred return and a 75-25 split. Same thing, if you bring in a larger check size, then you're able to get the higher preferred return and a higher profit share. But just to give you an idea of what that looks like on the back end, let me show you what that looks like. I'm going to skip through the slide in the interest of time. I feel like the next slide may be more educational. Okay, so let's go over this. As a Class A investor, right? And I'll talk about Class A. Guys, Class A is the class that is for investors who are looking for more cash flow, right? Now, it's a more guaranteed return compared to Class B because Class A gets paid right after the lenders, right? And then Class B and reserve class are pari passu, they sit side by side and they get paid after Class A. It's not guaranteed, but Class A does get paid before Class B and C. Class A investors also get depreciation. If you're wondering if you get those tax benefits, you do get the same depreciation for a 100K investment. But Class A investors are expected to get a 10% return annually during the hold period, right? And so that's what you can expect. That's a 10% average annualized return. This does happen to be tax-free. So I always say, just make sure you're taking the tax considerations, when you look at the whole picture. And so that's what you can expect as a Class A investor. This is for people who are, while we're here, I might as well just go over it. Tommy's just going to push your slides out a little bit, but just give me a minute. Class A is for those of you who are more concerned about higher cash flow today than looking for profit split on the back end. which gets you higher overall returns. It works well for people who are either retired, living off of their investments, want to cut back in medicine, and even for those of you who are risk averse and who want a more guaranteed payment and want to see more cash flow hitting your bank account, right? Now, Class B and C. Class C is for investors who bring in a higher, who invest higher amounts, and like you saw over there, they get the equity split on the back end is definitely the economics are enhanced, and so it bumps up what you get, and then this actually shows you what you would make if you brought in 500K for this investment. Class B is a 100K investment, and you can see that on average, cash on cash, the cash flow, right? This number up here is just what you can expect from cash flow during the whole period. That's on average about 5.4%. And then you get the rest of your profits on the back end, right? When we sell the asset, you get a profit split. And so 25% goes to the operators and 75% goes to our investors, which gets you to this number, right? That's what you can expect. Those of you who are interested in Class A, guys, Class A fills up really, really fast because it's also a smaller allocation. So those of you who are concerned more with cash flow today, rather than looking at higher overall returns, or if you're not interested in the back end split as much, then please make sure you go on to gwcapital.com/Nashville and submit your soft commit. Because that's usually what fills up within 24 hours of the webinar. So if you're thinking about Class A, please make sure you go soft commit. But that's essentially what the return profile looks like. And that's how, as GW investors, you get higher returns. We'll have a lot of time for Q&A on the back end, guys. So please put your questions in the chat and we'll get to it in the order. Now, in the deck, you also have sensitivity analysis, which shows what our projections are for when we exit, how do we anticipate the market to behave, right? And if it behaves worse or better, how does that affect our returns? All of this is in the slide deck. I'm going to go past this, but if any of you want us to come back to this, we can. In the interest of time, and because I just want to be more concise, let's skip past it. But before we move on to the actual, property slides and market slides, I want to reiterate this core concept. When we talk about an investment, when you're comparing investments, right? So for a lot of you, this is just educational. A lot of you are very interested in investing in this deal. I always tell you when you're doing your own due diligence to look at not just the returns, right? Because you're not comparing deals just returns to returns. You're also looking at the risk profile. And I want you to remember that this asset, because it's already completely rehabbed, it is a core plus asset, right? So your core assets are assets that are, say, brand new, great tenants. You're going in, good cash flow, but you're not really going to see a big upside on the back end because we don't have the ability to rehab and force appreciation and increase the value of the property, right? So it's more organic market growth. Your new development is when you go in and you build something from scratch, and you can get higher returns, but there are more variables there, construction costs, timelines, permits. So there's more variability. You're taking on higher risk for higher returns. Value add is where we go in and we do the rehabs, we bump up the asset value. This is the space we like to be in. We like to straddle the space. But this particular asset is more a core plus asset because it was completely rehabbed in 2020. Roofs were replaced in 2024. And so it's 5% cash flow day one, which is in this economic environment, which is great. And what it just highlights is that it is a core plus asset. It's lower risk, and so you're not going to see the biggest bumps on the back end on this deal. But it is a deal that is de-risked because of the fact that it doesn't have that variable where we're going in and rehabbing. So keep that in mind as you're assessing the risk return profile, right? And then this slide is again in the deck, and I'll let you take a look at it. But it essentially shows you what the business plan is, and a big part of this business plan, as I discussed before, was bumping up rents and getting close to market rents, getting close to what we can command because we have healthy occupancy numbers. We are in a strong position to do that, but also adding those washer dryer units and getting little pops here and there that contributes to the overall investment. And so this is a question. This is where we talked about the returns. We looked at the slides. I want to quickly talk about, for those of you who are thinking, how do I know if this is conservative? This is how I look at it as we underwrite, and Tommy and I have spent a lot of time underwriting this deal. How do we look at risk in this deal? And so, like I mentioned before, the first thing I look at is debt. We have fixed debt for 4 years at 4.89%, healthy loan to value ratio over here. So that is one of the first things I look at. It's fully renovated. And like I mentioned, because of that lowers risk in the asset because we aren't planning on renovating and then hoping we can increase rents and the market will, allow us to sustain that. So we are eliminating that variable over there. We have high cash flow day one, 5% cash on cash. We stress tested it based on our criteria and still cash flows positive, right? And so again, a big part of that is because of the debt we have on this deal, which is why, okay, the deal made sense. It checked our boxes, but high cash flow day one. We were able to get this deal off market with $1 million discount. But if you look at the purchase price compared to cost to build new and know that as as we go in, as we face more inflation, the cost to build new is going to go up, which is what also drags the value of existing assets, right? So there is a huge difference between what we're acquiring the asset for versus what we'd be able to if we had to build a similar asset from scratch new, what that would cost, right? And that increases demand in that niche where we are. Okay. Another thing we look at is DSCR, which is the debt service coverage ratio, which means our net operating income, our income minus expenses, except for the debt portion, how does that correlate to our annual mortgage payment? And the average DSCR for this deal is 1.65, which means that we're making, the net operating income is significantly higher than our annual mortgage payment, right? And the break-even occupancy, for those of you who've done this a few times and you're looking at this, what this number signifies is, hey, how low does occupancy have to drop from 97% for us to get to the point where we are now cash flow negative? And it has to drop into the low 60s for that to happen. We ideally want it to be at least 80% or lower. And so it just goes to show you the strength of the asset and the strength of the numbers over here. Again, like I mentioned, supply is what is affecting a lot of markets in the current economic cycle, right? Because March 2022, 2021, 2022, people were building like crazy because we saw all those rent pops. We saw inflation driving asset values up, but that pipeline is now dwindling down. So a lot of new supply is hitting some major metros, Phoenix, Dallas, and that will dampen rent growth. It'll drag down the ability for us to raise rents, over the next few years. Same thing with occupancy. But this is a supply-constrained submarket, which is excellent for us as investors. And like I mentioned before, it's affluent, it's a great submarket, A-rated school district, and 97% occupancy, which is, again, all of this just shows us that it is an asset with lower risk, right? As opposed to going into an asset with high 80s in occupancy. Even the business plan, the loss to lease means we're going to go in, market rents are lower than what we can command. We can bump that up. And that's low hanging fruit. It's a low risk strategy for us to go into. So again, those are the reasons why we love the deal overall. And so I want you guys to have that big picture. Again, this just shows you that gap, that housing affordability gap. It's really hard for people to go in and buy their own assets with where home prices are, with where interest rates are. And so there's a huge demand. Debt terms, sorry, Tommy, I didn't realize I had so many slides before we got to you, but
You're
we're
fine.
almost there. Debt financing, we talked about this, right? So this is one of the best parts of the deal, the fact that we have fixed interest rate at 4.89%. It's agency debt for the next 4 years, right? And then it gives us a lot of exit options. At that point, 70% leverage is a healthy leverage number, which means we're taking 30% equity, a down payment to the table, which is good. And the tax savings, I want to quickly touch upon this for those of you. We've been getting a lot of questions about this. But guys, remember, as we go through this, if you have more questions related to the tax part of it, please drop it in the comments. And then, Adrian, if you could do me a huge favor and grab it from the other platforms and drop it into chat also, that would be a big help. But we still have 40% bonus depreciation this year. And this is where we can accelerate taking some of those tax efficiencies, those tax losses on the front end, which means, based on what our CPAs have told us, these are just preliminary numbers. For every 100,000 invested, as a passive investor in this deal, you can get 25 to 30,000 in losses. Now, what does that mean? Those losses are banked as passive losses. So according to the IRS, for most of us, we have the active bucket for income and losses, the passive bucket, and our portfolio bucket, which is where our stocks, interest, dividends, all of that sits in the portfolio bucket, right? And so these losses are going to be passive losses. you get to use them against any passive income you have or gains in the passive bucket. So if you were to sell another asset and you have gains, the losses can be used against that. If you continue to have cash flow from the deal or from other deals, then these losses can be used to offset the cash flow in your passive real estate investments, which means that that hits your bank account, but you don't pay taxes on it. So it's essentially tax free, which is a beautiful thing. Now, we may go back to 100% bonus depreciation scenario. We were supposed to find out this weekend, but things have been pushed out a little bit. But things are looking positive, so we'll know more. But these numbers are based on if we do not get that bump up and we don't, go back to 100% bonus depreciation. If the Tax Cut and Jobs Act, the sundowning continues, and we're at 40% this year, you will still get these passive losses for a 100K investment. So just keep that in the back of your mind. And that's the tax efficiency where I feel like it adds a lot to your investments, which we don't see. If I invest in, all of us have investments in savings accounts, CDs, all of those all of that interest income is taxed at our marginal tax bracket. And so for most of us, for me, that in California, that's 50%. So that is huge. So keep those tax efficiencies in mind as you're looking to get to the right asset allocation in your portfolios. Okay, Tommy, all yours.
Nice. Thank you. Thank you so much, Param. I appreciate everything you shared. We can go we'll hang out on the next slide. And so while people digest this information, I'm just going to reiterate a couple high level things. I'm limited on time and not a respect of everyone's time. You're probably going to be seeing me skip a number of slides and chunks of slides at a time. Just know that the PDF is already readily available on the investor portal. The resources are there. If you have any questions about it, the link to schedule a call with the team is in the chat. So I just want to make you aware of the resources, but I just want to zoom out a little bit and just recap some of the high level things about this opportunity. So we have low leverage, we have high occupancy, and we have below market fixed rate debt, right? And so cash flow, it really is a defensive metric. I think depending on who you ask there, right? Is it a wealth builder or is that what you're looking for in your portfolio, right? To each their own on that. But we have so much staying power coming to the table with 30% of equity of the acquisition price. We could have stacked it with, supplemental mezzanine debt and on a spreadsheet that actually looks really good. We probably could have got 25 annualized returns instead of the high teens. But there's balance in all things, right? We didn't feel comfortable doing that. So we are assuming the in-place debt on this property has a little over 4 years left on it. So by the time that we close, which is going to be in 60 to 90 days, it'll be right at 4 years. So hence kind of the odd 4 year business plan, whereas traditionally we would be underwriting for a 5 year business plan. So here you can see a little bit about the capital stack. The occupancy, the note on the occupancy, that's actually been at this elevated level. And I would consider anything over 95 to be elevated. It's been at this elevated level for like 18 months. Right. That's really crazy to think about. And if you're a savvy investor, that should scream to you, the rents are low. Right. And so as we're talking about, the term is called loss to lease, right? The gap between in-place rents and where we can push them, right? There's room to play there, right? And so we're coming into this. And by the way, Param, if you can go to the next slide, I'll let people just kind of digest the information about the property while I tell the story about how this opportunity came to be, because everyone's here is thinking, oh, yeah, I could go out and get this. But the reason that we didn't buy anything in Q1, or we didn't bring an investment opportunity, or we didn't bring an opportunity to invest alongside us in Q1, was because it requires patience. So this deal was actually under contract by a different group. They failed to close, and the buyers came back to us and said, hey, would you be interested in taking another look at this, right? Do you have bandwidth? And so we said yes, but our price isn't going to move. Right, our price is our price, and said, all right, you know what, that's fine. If you give me a surety to close, I'll sacrifice price. And so here we are, right? So that's the $1 million discount that Param was talking about. We said, you know what, I'll settle for best and final. This is our number. We're sticking to our gun. And so that's how it came to be, relationships. And there's so much power in the follow-up in today's environment for real estate. Like, that's how deals are found, right? If you're saying, how do you find something like that? That's how deals are found. The seller is selling because they are a fund, right? They're institutional. This is an institutional quality asset. If it's not obvious by the size of this, right? You're talking 200 plus units. It's basically a small village. The seller is a fund, and they are closing the fund, right? In order to close the fund and liquidate the asset, right, they have to sell, right? And so here we are. We're on the receiving end of that one. They know they know better, right? If they had their druthers, they wouldn't be selling in an environment like this, but they got to get their chips off the table. They said, hey, well, we've met our investors' returns. We want to liquidate and we want out and we want to ride off into the sunset. And so we said, hey, we'd be happy to acquire it in one of the hottest markets in the US. So yeah, so this is a 1985 year built. This does get us past the 1970s kind of minutia of, aluminum wiring, Pelco panels, and crappy plumbing. So solid infrastructure, solid bones here. Perrin, we can keep moving on to the next slide with the business plan. And so there's going to be a little bit of a rebranding. As far as the increasing the income, there's already pretty good structure for other income on this property. They have tested installing washers and dryers into the units to see if the demographic can support that or has an interest in that one. The majority of these units are one bedrooms. And so we were a little surprised to find that it was very receptive. So we're going to keep building that out and keep doing it until it doesn't work. So but mainly the substantial gap in current rents and where market rents can go is really going to be the bread and butter here. So we're not going to be kicking people out and saying, hey, your rent is now $1,600 on a one bedroom unit. That's not how this works, right? We're targeting just modest increases in rent, and then over time, making sure that the operational expenses are in line, not getting out of control. And thankfully for an asset like this, you can afford really good on-site personnel, right? With decent benefits, you can attract and retain on-site talent to manage and run that property to your high standards. So we're excited for that one. Perrin, we can keep going here. There's a lot of these are just kind of property summary slides. If we go to, can you go to slide 49? I think that was the left back to
Oh, you want me to go back, correct?
yeah, the property information and the property construction overview. So for the detailed junkies out there, right? This is, if you're watching the video, pause here, take a snapshot. You want to know what all the finishes are. They're actually really comparable to new product, right? If we did build from the ground, we talked about building from the ground up and what it would take. There's not far off if we're talking about the finishes there. So take a screenshot, whatever you want there. Like these are really strong finishes for the market. I'm not going to say that they're top of market, but for the vintage and the demographic that's there and where the rents are, I think they're a little undervalued. So we're excited for that. But like you can see the leasing fees in the bottom left. So we're excited for just kind of continuing that, building upon that, the other income streams, maximizing those as much as possible. The washing dryers, amenities are going to help. And then we can move forward a little bit for the community amenities. So we've got a gym, we've got a dog park, we've got a tennis court, right? You think of all the amenities that go into something that's built today, like we're not far off. There's minimal capex budget, capital expenditure budget for interior renovations, right? Because all the units are already renovated, but we're also budgeting some for exterior. So right now we're playing around with do we paint pickleball lines on a tennis court, right? So that's some ideas that's being thrown around right there. But it's really strong amenities for an asset like this. So, Parent, I'm going to have you jump ahead to the, can you go to the unit interiors, please? Okay, there you are. Right. And so while these are one bedrooms, they still like they're pretty large. Someone threw out the term almost like a cottage, right? So they're one bed, one bath. They're not studios, right? So they are still pretty good sized units there. And so yeah, walk-in closets, granite countertops, stainless steel appliances. They're not messing around. So we're excited to be inheriting an asset like this. Right. And if you're, yeah, let's take a look at the comps here. And so you can kind of see we're not taking comps from Nashville. We're not taking comps from Huntsville, Alabama. We're not taking comps from Lexington, Kentucky, right? This is a 135-mile radius, direct comps. And so you can kind of see like we're not off base whenever we're trying to justify where we think rents are going. If you look at the occupancy for some of these, that unit that's renting at what 1,600, 99% occupancy. And so bear in mind that, the price per square foot makes a factor, the floor plan makes a factor. But yeah, we are excited for the loss to lease burn off because that is the easiest value add component in a value add business plan. We are not juggling chainsaws, trying to do interior renovations as people are moving out and increasing rents and that whole game. So if there was ever a headline for this opportunity, it would be value add returns without the value add risk. the reality is in real estate, you can never eliminate risk, right? Yeah, and I guess that's probably universal for all investments. But what are we doing to mitigate that? Is a question that should be top of mind for you. That's a question that's top of mind for us. What are we doing to de-risk the deal? What are we doing to mitigate the risky points of the deal? Because we can't eliminate it, but we do feel comfortable how we are managing risk on this asset. So if you're asking, so this property is in Hendersonville. I'm sorry, I jumped ahead there, Param, but if you don't mind, just one more forward.
Just move forward, Tommy.
Yep, one more forward. And so this is a slide where this really illustrates the the new supplies, or I should say the lack of new supply and the lack of new deliveries that are coming online. Right, it's a joke. And so look at Central Nashville. I still remember looking at all the reports of how there's 20, 30, 40,000 units coming to market over the next 12 months. This was, 2 years ago, back when Urban Land Institute rated Nashville 2 years in a row for we think this is the best market to build in. Well, they did it, right? Central Nashville is oversaturated. Thankfully, Hendersonville, they've got a fair amount of conservatism when it comes to building new assets and what the local municipalities really want and deserve. And so, yeah, 250, right? Not even a four-digit number, 250 deliveries over the next 12 months. And so, we're excited for that. So, whenever we're talking about supply and demand imbalance and kind of justifications for where we are in the market, that if we were being really speculative, we would probably underwrite for about 5% rent growth based on that supply number, right? We're not doing that. So that's just kind of one way that we're being conservative. We're just sticking with historical norms for underwriting for rent growth there. But that should be an opportunity to be mindful of. And I think that when it comes to be 2026, you'll be looking back saying, oh, I really should have taken that data point a lot seriously. Okay. Yeah, this is an interesting slide. So replacement cost is one of the lenses whenever we're evaluating investment opportunities. It's one of the lenses at which we look at the deal. And so really all this, I'm just going to summarize this slide really quickly. Really what this is saying is that if we underwrote this as if we were going to build brand new, what would the in-place rents have to be to justify a $76 million investment to build this asset brand new? And the rents would have to be 2,500. Right. I think you saw we were topping out at around 1900 for a couple of, like, the market's not there. There's no way that this would ever be justified by anybody. So other things to think about as you're kind of weighing the supply and demand imbalance, and that really doesn't justify bringing in new supply into a market like that. We can keep going. We are a little bit tight on time. If you want, I'm basically just going to do like a one-line headline for some
Go
of
for
these
it.
components about Hendersonville. But Hendersonville, so there's basically three paths of progress around Nashville. There's two on the south side and one on the north side. Hendersonville is the one on the north side. If you've got Google Maps open, you can look at Hendersonville, Goodlettsville, and Gallatin. They're kind of a little triangle. They're a suburb of Nashville, but they're a little bit further out. They're 20 miles away. But you don't. My opinion is you do not want to be immediately in Nashville. You want to be one click outside of it. So this is one click outside of it on the north side. Facebook is building a data center. We're going to blaze through this. You're going to see some other developments that are going on. But historically speaking, Nashville has been a town of eds and meds, right? Education and medical. So there's something like 17 hospitals in the Nashville metro. They've got universities, Lipscomb, Tennessee State. There's a couple other ones that are in the slides. We can keep going here, but that used to be the basis for the economy in Nashville. Fast forward now, Oracle has already signed a land lease. They've been slowly building out their campus. Facebook is building a data center in Gallatin, which, if you recall, that's one of those tri-cities around Hendersonville. So Hendersonville is in between. Sorry, I'm getting some storms here. Hendersonville is between Gallatin and Nashville, right? So as we're talking path of progress and kind of the evolution of where people are moving directionally, it's really impressive. The household income is worth mentioning. I'm glad you stayed on this slide, Param, because if you look at the census tracts, you can kind of use that as one measuring data point to determine where the path of progress is. And so if you look at the census data for area median income, and you kind of see that it's growing in across consecutive income tracks, like that's one data point that you can infer what a path of progress is. So the average household income is over $100,000. If you look at our measly $1,200 a month rents, right, it's a drop in the bucket, right? So it's a very affordable market that we're in. We're excited to be there.
I'm assuming we're just going past a lot of these market slides, right? Tommy, all of you
Yeah.
have access to this in the slide deck. It just goes to show you how strong the submarket is and all the economic drivers for the Nashville, region per se. Let me know if you
Yep.
need me to stop anywhere, Tommy, or we can just go through this. Just in
You're
the
good
interest of time, we're getting close to the top
yeah.
of the hour. So, guys, all of this is available in the slide deck on the page, including our performance and our partners' performance. All of this is available for you on the slide deck. Do take a minute to take a look at it. I guess I always wrap it up with, why are we investing now? And it comes back to a lot of the talks. I mean, I was at White Coat Investor Conference earlier this year, and my talk was on the psychology of investing because for investing, although we think a lot of it is strategy, 90%, 70, 90% is how you approach market timing and market cycles and how do you navigate everything that's out in the media. And I think it's a great point to make over here. March 2022 was the peak of the market cycle, but everybody had seen all those rent jumps, had seen the massive high inflation and real estate being a leveraged asset, prices going up significantly, and everyone benefiting. And that's when everybody wanted to invest in real estate. Everyone was excited about real estate. And now we're at the bottom of the market cycle trending up, just based on the inversion curves, based on rent growth starting to pick up and occupancy starting to pick up in most markets. We're headed upwards, but this is also the point where there is a lot of uncertainty, especially with Trump's tariff policies, the economy, inflation, interest rate volatility, a lot going on, right? There's a lot to take. I've done so many podcasts in the last month about how do you look at this and what do you invest in when there's so much uncertainty, and why does real estate still make sense, right? Because it's a real asset that's cash flow positive and it's leveraged. And there's no reason why your portfolio shouldn't have 20 to 40% alternative assets, right? And that's what I keep coming back to. But it's also the time when it's the hardest for most of us to make that decision and realize that, this is also the time of maximum opportunity. And it's important, like with the stock market, to constantly dollar cost average, make sure you're getting it at different points. So, and stay, right? And having the ability to stay so that you can actually benefit from real estate. So it's not about timing the market. And this is why when I talk about de-risking the deal, the first thing I talk about is debt, because having the right debt gives us the ability to hold on to the asset, which allows us to weather volatility, right? And if you look at historically, this is what happened with rents historically. I believe this is for uh, okay, so this may not be the actual metric I'm looking for. But if you look at rents, if you look at this graph over here, the red line is home prices and how that fluctuated over decades, and the dark blue line is rents. And asset values can go up and down, right? And the peak of the current market cycle was March 2022, and we're now at the bottom and looking to go upwards at this point. But as long as you have the ability to hold on to the asset, and as long as it's cash flowing, you'll see that there aren't all those the same volatility doesn't exist in what you can command in terms of rents, right? Rents can drop by 5 to 10% in each market cycle. In the worst market cycle, after 07, 08, rents dropped by 4% one year, 5% the next year, and then went straight back up, right? So that's an easy volatility to weather, especially if you have positive cash flow, which is why that's the second thing we focus on, right? So having the ability to hold on to the asset so you can weather volatility, knowing that in the long run you will do well when you're buying right assets. And so I just want to highlight that, right? This is still one of the best times to be investing in real estate, which is why opportunities like this, as hard as they are to come by, are a good way to keep diversifying, keep adding to your portfolio. And I mentioned this before, right? High yield savings account. If we are in inflationary environment, if that's what happens, with the policy changes, then although you're making 4%, and if interest rates drop, you're not going to be making 4% on your high yield savings account. But even if you do make 4% and you get taxed on it at your marginal tax bracket, you're getting a 2% ROI. And oftentimes that's not even keeping up with inflation, right? So your purchasing power is eroding. So there is a place for fixed income assets in your portfolio. Ideally, that's not more than 20% of your allocation. And I say this because I've made this mistake myself for years. But I want all of you to be very intentional about how you're building out your overall asset allocation and about continuing to invest through market cycles by leaning into the fundamentals and by leaning into data rather than listening to media narratives, right? So we just need to look into the fundamentals, and it comes back to Warren Buffett's quote, where you want to be countercyclical, right? And because there's value in it, and that's what we're trying to show over here. And so, if you look at this slide, I mean, I've been repeating the slide for years now, and that's because the fundamentals essentially remain the same, whether it's a seller's market or a buyer's market across all market cycles, right? As long as you're buying in strong landlord-friendly markets, you have positive cash flow day one, you have adequate cash reserves, and you have the right kind of debt on it, and your underwriting is conservative, then you will do well, right? And that's what this asset brings to the table, and that's what we've been trying to kind of elaborate. So you have those data points as you make your decision, all right? And when you invest in a part of the market cycle where you're getting discounted assets, then you get to see outsized returns, right? And something to keep in the back of your mind. Few questions that come up. We've addressed this, but just reiterating this, the expected hold term for this asset, we're underwriting it for 4 years, which coincides with the end of the debt term. And again, at that point, if the market is in a position where we are positioned to sell and that makes sense and we can hit a pro forma, that is what we'll do. If not, we can refinance, and having an asset that cash flows well and has a healthy DSCR is always helpful in that sense. Minimum investment is 50,000. And yes, you can use retirement accounts. And the problem is, and just from an education perspective, right? For most of us, as we're trying to rebalance our portfolio, the bulk of our savings and our investments are in our retirement accounts. Therefore, you can, yes, if you are looking to use your retirement accounts to start reallocating to real estate, 2 points to remember: if you have funds outside of your retirement accounts, they're probably you're best suited to use those funds to invest in real estate because it is a tax efficient vehicle. But if that is not an option and you're looking to use retirement accounts, then shoot us an email. We'll connect you to our IRA custodians that we work closely with, and they can help you set up a self-directed IRA, and you can invest in real estate through that. Class A or Class B, kind of touched upon it, right? And so we talked about the capital stack, right? Class A gets paid out right after debt. So it's not guaranteed, but there's more guarantee of payment and less fluctuation in terms of what you can get from cash flow hitting your bank account. And it is mostly for a person who is seeking safety, either because they're retired or cutting down at work, or because of their risk appetite, right? And B and C returns, that is more for someone who wants that velocity of growth more than cash flow, right? And so you're getting some cash flow, right? You're still getting between 5 and 6% cash flow during the hold period, and that is tax free, and that is hitting your bank account. If we hit pro forma. But you also get the split on the back end, which bumps up your overall returns. And if you go back to those slides, and that's in your slide deck, you'll see that the average annualized return and the IRR, internal rate of return, is higher for Class B investors because of the pop they get on the back end, right? And so this is for someone who really wants to, two-income household, young family, you're looking to grow your capital and maximize your returns. And that's for someone in that category. Like I mentioned, if you're looking for Class A, please take action right away because Class A tends to fill up much more quickly because it's a smaller allocation. And historically, 24 hours after after the webinar, we filled out Class A. So please take action quickly. And then we are investing again through the fund. And so sometimes we have questions about GW Capital Fund 1. The fund is a customizable fund, which means you get to pick and choose which assets you go into. It's not a blind fund. You decide how much you want to put into each investment. So you do your own due diligence. It still allows you to stay completely personalized. So you could have two people in the fund who invest very differently, and it allows for that. All right. it does give you diversification. It still gives you all the tax efficiencies. But that's how we're able to negotiate higher returns for our investors, which is why, as a GW investor, you get higher returns. And the way we've structured it is we bring in a lot of those functionalities in-house to reduce the costs by 75% for the fund, which means that we're still able to give you higher returns than the retail investor because we aren't passing those costs on to you. You also, a lot of you probably received your K1s for 2024. It's simple. It's like investing in Merrill Edge and having multiple, being invested in multiple funds and getting a single K1 end of the day, which you can give your CPA. So it just simplifies the process for you. It's a better investor experience. We're super excited for our second year in the fund at this point. I want to quickly touch upon next steps and timelines. Now, our fund is a 506c fund, which means you need to be an accredited investor to invest. Most of you meet criteria. If you have any questions about this, drop it in the chat or book a call. You need to be earning 200,000 individually over the last 2 years, or 300,000 as a couple over the last 2 years, or you need to have a net worth over $1 million, excluding the value of your primary residence. Again, investment timelines, last day for soft committing is May 31st. And then June 15th is the funding deadline. And then we'll be announcing the closing date as we have more information. But it's gwcapital.com/Nashville. And I would highly recommend the soft commit is holding your spot, almost reserving your spot. So I would say please do that if you're interested, because because after the webinars, we have a ton of momentum. But yeah, that brings us to the end of the presentation. Tommy, anything you want to add over there before we go to Q&A?
No, I think you hit the nail on the head. You touched on a lot of critical points there.
Awesome. Okay. Let me see. So
I
many of
guess
you
I
on
have
here.
been tackling some of the questions in
Oh,
chat there. So
okay.
try
Great.
to find some without my response.
Makes sense. Let's see. Hey, Adrian, can you drop any other questions we may have in here so I can take it? And the Physician Freedom Summit, Kanya, it's for all professionals. It's not restricted to physicians. We have some of our cost segregators and IRA custodians who love to educate, who are going to be speaking also. Yes, it's not restricted to physicians. The majority of the community is physicians, which is why most of the time you'll hear me say physicians, but it's not. Natasha, the link to the guide is, I think Adrian already dropped that in there for you. It's gwcapital.com/guide in lowercase. And then Shri, I think I see Tommy has answered your question. Thank you, Adrian, for dropping those links in there. Okay, so Kevin, how is the 17 million in equity in 4 years estimated? If this is a core plus investment, how do we expect a 40% increase in value? Kevin, what we're going to do is we are going to do an underwriting walkthrough. So we'll make sure, Tommy, when we do record that, we'll make sure we send that over to Kevin. We'll also include a sources and uses table in there so you can see what all the equity that's collected, all the places it's going into. Now, the 40% increase in value, we'll actually go over that specifically in the underwriting video, so keep an eye out for that. And then again, know that when we see a bump in equity, given that it's leveraged, then that does boost our returns. So I want to make sure I'm addressing the right metric, and without actually having the underwriting in front of me, it's hard for me to know what the exact value is that you're looking at. But what you can also do, Kevin, is book a call through one of the links that's on here, and then we can actually go over the underwriting spreadsheet with you. Hey, Archana, is there a plan for increasing, if there is a plan for increasing the rents as a means of increasing value, have any reason the rents have not been increased by the prior owner? So usually it's cyclical, right, Archana? So they did their rehab in 2020, and there was a lot of rent bump happening between 2020, 2021. Oftentimes, if you have longer leases, you're waiting for people to renew their leases, or you're waiting for a new tenant to come in before you can bump the rent. So it does take a little longer for those rent bumps to be seen. But as we go and execute our business plan, we have the ability to do that, especially in the first few years of acquisition. As we're seeing turnover, and like Tommy mentioned, we're not bumping it up right away. We have to wait and time it appropriately. And so that's where the lag often is. Tommy, if you see any of these questions that you want to tackle, please feel free to unmute and take them. Hi, Nicole. Your question is, nice to see you on here. For the difference between Class B 8% preferred equity versus the projected annual return? Yeah, that's a great question, right? Especially for those of you, I mean, Nicole does a lot of underwriting, and so, and you know this, you've gone through our coaching program, but there's often clarity required around, my cash on cash is about 5.4%, but my preferred equity is 8%. What's the difference between those numbers? And so the cash on cash is actually, your the free cash flow from the asset that we have annually that's distributed out to investors, right? And a preferred return is generally how the splits and the returns are handled on the back end. So suppose you get 5% cash on cash return in year one, and year two, just for ease of understanding, year two, you get a 6% cash on cash return. Year four, you get a 7% cash on cash return. I'm sorry, year three, you get 7%, and year four, you get 8%. So year four, you're actually caught up on your preferred returns, right? So the goal is to give our investors 8% returns for every year that they're in the deal before we before we calculate the profit and do a profit split over there. That is the 80-20 split, or the 75-25 split, right? That is a split between the general partners and the limited partners. So before that even happens, we want you to get 8% in returns for every year that you're in the deal. So this actually protects our investors, and it also incentivizes operators in general to work hard so we can actually exceed that and get to the point where we start getting a portion of the split on the back end, right? So there's alignment of interest over here. And so in this particular example, the first year on the back end, when we sell, the profits are taken, and first our investors are made, or like say our Class B investors are made whole for their duration. So you will get an additional 3% for year one that you were in the deal in terms of your return on investment, right? For year two, you get another 2%. For year three, you get 1%. So it's getting you to that 8% in returns for every year that you were in the deal before the profit split is calculated. And and then that's on the back end, because Class A, you know, in any reasonable scenario should get their 10% returns during the hold period. Class B, the returns depend on free cash flow, and if we aren't hitting that 8% preferred return, then it keeps accruing, and you get paid that out on the back end before the profit split is calculated. And I just happened to see, Tommy, that you've already answered this question, but I hope it was helpful for others. So yes. Okay. Let's see. Uh, can you use bonus depreciation from year one? This is a direct message, so I'm going to keep the name anonymous. But bonus depreciation is usually distributed to our investors, so it's going to be on your K1 year one, right? That's where you get the bulk of the losses, and there is time value. This is where a time value of money comes in, right? So if you are bonus depreciating, you want to do it early so you can have those losses, bank them, and then some of you may be using it potentially against other passive income you have from short-term rentals, or other passive income you may have from your surgical centers and endoscopy centers, right? Or exits you may have with other deals. So you can use it for anything in that passive bucket without having to take it, as straight line depreciation. So bonus depreciation really is probably the way to go for most investors, which is why we bonus depreciate year one. After that, you will still have depreciation. It won't be as sizable, because bonus depreciation is only for for the components of the building that have a useful life less than 20 years, right? Therefore, do get a bulk of it. So for every 100K investment in this deal, you'll get 25 to 30,000 in passive losses upfront if we bonus depreciate at the 40% rate. Now, if that goes up to 100% bonus depreciation, that's going to be about 60 to 70,000 in losses for every 100,000. Those are going to be passive losses. They will sit in a passive bucket. You will continue to get more passive losses throughout the hold period, and that's for the building components that have a useful life greater than 20 years. But it does allow you to maximize using your losses, passive losses, especially if you have other sources of passive income. So if I had a short-term rental where I'm getting 20,000 or 30,000 in profits every year. And so I know Abhishek, you'd asked me this question also previously, right? So if I'm getting, let's say, for ease of understanding, 50,000 in passive income from my short-term rental that's not offset by my losses from depreciation because I bonus depreciated it upfront. And so I'm getting 50,000 in income that exceeds my losses from that asset, and it's passive now because, year two, I'm not materially participating. I'm paying marginal taxes on that passive income. But if I get my bonus depreciation from my syndications, then I can use that against, you can do a grouping election, you can use it against your passive income from other sources, and you can reduce your tax liability. I hope that makes sense. Um, Shri, there's a question, and I think Tommy has answered that, so I'm going to skip it. Okay. Oh, Kanya, great question, and I should include this in the slides. The question is, when will quarterly distributions start? Distributions will be monthly for this asset. Tommy, correct me if I'm wrong. And it will start after the first full month of ownership. So if we close end of June, July will be the first full month of ownership, and you'll see the distributions hit your bank account in the first or second week of August, which will be for the month of July, and prorated cash flow for the month of June. And that's typically how it goes. Okay. The call talk, let me open that. Adrian, thank you for that.
There's no questions from Facebook.
Okay,
It's
awesome.
the short answer.
Thank you. I appreciate that. The link to the guide is in there. Perfect.
But there are some questions popping up at the end of
Yes,
the chat here.
I'm seeing those. If you want to grab some of those, that's fine, Tommy. If not, I'll just get to some of those. So Archana,
Sure.
I'll take Archana's question, and if you
Go
want to
ahead.
take the next two, Tommy, awesome. So Archana, what does depreciation look like every year for the next 3 years for a 100K investment? Rough numbers. Ooh, it's hard for me to say, but usually it's between 6 to 7K after the asset has been bonus depreciated. Is typically what it looks like for most assets. Again, that's just a gestalt number. Tommy, if you want to add something, if not, you can move on to the next question.
Yeah, a notable drop off in losses year one to year two, right? And if you spread your CapEx budget and your construction spend over 2 years, right, you get elevated for those years, but substantial drop off after year one, which is why some people marry the investment with some of their liquidity events, right? If they're exiting a business, they want to offset some losses accordingly. Um, so yeah, I'll leave it that one there.
Awesome. Do you want to take the next one?
Yeah.
Oh, I can actually take that, Tommy. That can be 1031 the investment at the end of the 4 years. That is our goal, and that is usually written in our PPM. That's pretty standard for most of the deals we enter into. I think maybe Tommy, we can actually look into that and specifically talk to our attorneys and get an answer. But most of the deals, our PPM is structured where we will have the ability to 1031 into the next asset. Now, knowing that, if we go into a scenario where we have 100% bonus depreciation, and if we don't see sundowning and we have 100% bonus depreciation for the next 4 years, and we're exiting the deal and we have 100% bonus depreciation, you may be able to get away with a lazy 1031, where you don't need to do a traditional 1031. As long as you exit this deal and enter the next deal in the same year, then you're still able to get the same tax efficiencies, right? So keep that in the back of your mind. And another point to remember is that that is sometimes more beneficial, because when we do a 1031, the entire LLC needs to 1031 into the next asset, which means you are tied in with the same team. So, I mean, just so that you realize, if you have the ability to do a lazy 1031, or you have losses from other assets, right? Like Tommy was saying, if you're banking passive losses from other assets and you can exit and those losses will offset the gains at sale, then that's another way to avoid having to do a 1031. So a great question on the back end when it's time for it the exit is to talk to your CPA and just make sure you know what your options are, right? And so that's the beauty of really understanding the tax implications. We actually even have a podcast for how all the different tax strategies that passive investors can use as they're entering and exiting deals. And Adrian or Tommy, if one of you can pop that in the in the chat. That I think that'd be super helpful for everyone. But if not, guys, it's in the Generational Wealth MD podcast. That's on Spotify. It's on Apple, and you go to tax strategies, and there's an actual episode for tax strategies for the passive investor. That works for those of you who are investing passively, either in long-term rentals or syndications, and how you can strategize around taxes. And I think that's a valuable, episode to go back to. Okay. Hey, Jitendra. Sorry, Tommy, do you want to take Jitendra's and Kanya's question?
Sure. Yeah. Jatinder asks, can passive losses be carried over from year over year? And so, yeah, it's quite common if you're, let's just say a single family home, right? If you buy a single family home, you get straight line depreciation. That passive loss is going to be used to offset your passive income. In the event that your passive losses exceed your passive income, that's carried forward into the life of the asset. Right. So if you never sell and you continuously have more and more passive losses, you'll accumulate additional passive losses over time. So yeah,
Yeah.
hopefully that answers your question.
Yeah, absolutely right. And then, like Tommy said, with the single family asset that you own, as long as you hold on to the asset, you're able to carry it forward. In the case of syndications, when you exit, if you decide not to 1031 into another asset, then those passive losses will be used to offset depreciation recapture, most often. And I mean, technically, they could be used to offset gains also, but oftentimes you have depreciation recapture that needs to be offset. And so that's why the 1031 is such a powerful vehicle, because you can kick that down bucket down the road without having those tax consequences. Okay, awesome. I see Abhishek saying he's dropping off for a deal he's closing. I'm excited to hear what you have coming up, Abhishek. Abhishek is one of our students from the coaching program, and he's just been doing amazing things. He's such a resilient, giving individual, and he's just a valuable team member. Thank you so much, Abhishek, for that. Yes, Tommy, he's going to connect with you. So, oh,
Mhm.
perfect. I see that you've answered Kanya's question. Awesome. Hey Spencer, nice to see you on here. Aloha. Spencer's from Hawaii, and he's also in our coaching program. He actually got the scholarship to the program last time, and he's been showing up and learning and absorbing. And I'm hoping that all that we're doing over here helps a lot of you take action, which end of the day is the goal, right? And so at the moment at the end of the questions, we are 20 minutes past the top of the hour. So we have one more question from Krishna, so we'll probably stop here. But guys, again, Tommy and I were here to support you, and super excited for this opportunity, especially in the current economic environment. And we're here to really go over any questions you may have. So feel free to use those links. And you can even go to gwcapital.com, and there's a link to book a call with the team. Please make sure you do that. And especially if you're thinking Class A, just take action quickly, at least reserve your spot. And then, you can have a conversation with us, because that does fill up very quickly. And there's really not much we can do once it does fill up. Krishna, your last question is, can you exit before 4 years? And if the 4 years of the property is not sold, Tommy, I'm just going to have you take that.
Sure. Yeah, and so I guess the short answer is it's possible, right? Anything's possible. The loan term is for 4 years, and so we do have the option to sell. Let's say interest rates go to 0%, the day after closing, and of asset valuations start to go sky high, and we're like, hey, well, let's take some chips off the table. Let's take this opportunity. If we're still hitting our metric for investor returns, we'll highly consider it, regardless of the timeline there. If the other question, I'm making my own questions here. If the other question becomes, what if it's year 4? Like, what's the plan then if we want to hold on to the asset? Really, our plan is to execute the business plan in the first 12 to 18 months and wait until the right opportunity, right? And so typically that's going to be waiting till the debt cycle gets into an advantageous part for to favor real estate valuations. So the question then becomes, do we think that we will have a favorable environment to sell in the next 4 years? I'm optimistic. I'm bullish. But 4 years is a long time. Anything can happen in 4 years. The further you get out, the harder it is to predict what's going on. And so at the end of 4 years, we have the option to refinance and hold on to the asset again, maybe pay out some investors that want their money back, and hold on to the asset, or do we just sell? So right now we're just targeting a sell. We didn't want a complex pro forma or underwriting or anything like that. So we said, hey, just the simplest business plan. Does this deal work? Yes. So that's what we're modeling. But we may seize the opportunity earlier. We may refinance and hold on to it longer if we're in love with the asset.
Yeah, absolutely. And I'm not sure. I'm just reinterpreting this question. And if it means, can an individual investor exit the deal? For the most part, it is illiquid. And so you would exit along with everyone else at the point where we sell or we refinance and you get your capital back. But yeah, awesome, guys.
Great
Okay,
points.
everyone, thank you for your patience. We still have 40 of you on here. We again, we're here to support you. If you want to set up a call, please feel free to do so. But and then you can post your questions in Facebook and tag us, and we can answer questions over there. But yeah, feel free to reach out, guys. And if we can do support you in any other way, more than happy to do so. David, your question is, hey, Viren, is this property a part of the GW fund? It is part of the GW fund, but like I mentioned, GW fund is not a blind fund. It is a completely customizable fund, which means you can go into each asset and decide whether or not you want to invest and how much you want to invest within it. So, yeah, so it is customizable. It's essentially the same as going into multiple of these separately, except now you have enhanced economics. You get better returns because we're able to negotiate that through the fund without any additional, drag because of fund fees, and we've been very careful with that. And then you're also able to get a better experience because, single K1 and everything's in one place. So awesome. Thank you so much, Tommy, for your insights. I love that it's less than an hour from where you live, right?
Right. Yeah. Not too
Yeah.
far. I'm
Yeah.
on the south side. It's on the north side. I'll be going there tomorrow.
Yeah, yeah. And yeah, okay, guys. Well, nice to see all of you on here. Hey, Gotham. Hey, Rose, Kevin. I feel like saying hi every time I see him. Lubna and I spoke earlier today. Um, uh, Tom, if you want to just take a few questions that are probably dropping, if you want to just type in the answer. Hey, Jatinder, Whitney. Okay, guys, Viren. To see everyone on here. We have we have a state of the market on Thursday where we're talking about, overall economy. And Tommy and I have been pouring into it. I'm getting all, everything ready. So I'm hoping to see a lot of you on here for that. We'll see you guys then. Okay, Tommy, if you're all good.
So,
Adrian, thank you so much.
David,
Dropping
I'll circle
off.
back with you on your last question, but we got to run. Thank you everyone for your time and attention. There's a million other things you could do on your Tuesday night, but y'all are crazy enough to hang out here. Thank y'all.
All right. Thank you, Tommy.